Hey guys, welcome back to the Capital Mindset Show. Today we're going to be doing the first episode in the series, such as, the Capital Mindset course that will be hosted here on YouTube. So now we're going to be going over some of the basics, and as kind of the episodes progress over time, it should get more and more convoluted, more and more complex, and more interesting for some of you more advanced guys. But I think that anyone can kind of find value, at least in the very points of some things that you want to cover if you're going over and teaching someone else or kind of getting someone else into this. And if you find value in this video, you can feel free to share this video with other people who are kind of wanting to get interested. And I'm going to be going over some of the basics. I know some of them are going to be pretty basic, but bear with me for the most part. So we are going to be going over first, what is an asset? And I think that's kind of going to be the primary focus of this part. So an asset is a resource that can be owned by an entity that can produce a future economic value. So it's very important. I'm going to highlight some words here for you guys today. So can be owned. Okay, so this is a very important word. Owned by an entity. This entity can be you, a business, etc. And then can produce future economic value. So you think of this typically in monetary fashion. So it produces a monetary value. Now, in a lot of instances, you might be able to kind of derive a sort of value from, for example, your shelter. Your shelter provides a value in the sense that, you get to live under it. There's a use case for it. So in that way, we might say economic value can be a little bit more broad, not necessarily all the time kind of concentrating under that monetary value, but typically what we mean about it in the business world is producing a monetary value. Now, some examples that you might think of is real estate, companies/stocks, and bonds. Okay, so if you've never heard of a stock, but many of you have heard of a stock, what I want you to think of as stock is ownership in part or whole of a company. Just depends on the percentage that you own. And with owning a stock, you get rights, benefits. Okay, so what are the rights? Well, rights of ownership is very important. And in fact, something I implore everyone to kind of be cautious on is when you're investing out there in the world, make sure that the jurisdiction has those rights protected. That's actually a very important component of actually, market-based forces. So if you're going to be an investor in a country, you want to make sure that country has a lot of protections onto you, the owner. Okay, so it's very important. And in a capitalist system, you are the owner or you are the entity that owns the asset that derives future economic value. Okay, so that's the key difference there. Instead of the state ownership, it's you, the individual ownership of the means of production. Okay, and so you want to make sure those rights are protected. And with that, you should be able to derive benefits from that ownership in the form of profit. So when your business produces profit, you should benefit. You should receive the benefits. And then another thing you need to focus on is the risk hierarchy, or risks associated with ownership. Well, you being the owner, you stand to benefit the most should things go well. But should things go poorly for you, you stand to lose everything. And the hierarchy is pretty simple. Well, at the top, you have debt or bonds. So we'll just say bonds, okay? That's at the top. So if anything goes bad, they get covered first. Then afterwards, you have preferred stock. We won't really cover that much in this video, but preferred stock is another form of debt. It is senior to stock or common stock. Common stock, I'll label it as CS. So common stock, this is what you do when you buy, for example, Apple stock. What you're buying is common stock. And this is at the bottom of the hierarchy. So you stand to benefit the most should things go well, but you also stand to lose the most if things go poorly. So a bondholder gets a fixed amount. So this is fixed, right? And so is the preferred stock to a certain degree. It is less fixed than the bond holding because a bond holding has a maturity date. A preferred stock has kind of like an infinite flow of dividends up until it's paid off, okay? But they don't get an increase in that. While a common stock has, in theoretical, infinite potential return. So infinite potential return there, but also the full bearing risk. So you are basically being rewarded for the risk that you take. And a lot of people kind of misconstrued this with, you're kind of getting some outsized benefit or advantage. And this is, of course, always stated at the end of the story playing out in a good way. It's never told, for example, for that investor that invested in a company that went bankrupt and, they're like, you took on all that risk. No, they never like to talk about that one. They always like to talk about the good ones, the guy that invested, back in the olden days, and then now the portfolio is worth millions upon millions upon millions of dollars. And, now they're saying, you weren't taking on any risk. No, they were compensated for the risk. That's actually why they had those returns. So I want to actually go over some key, points. We want to talk about index funds. And I'm going to be showing you guys some index funds. So index funds have a variety of benefits associated with them. And I'm going to kind of talk about some of the different benefits. So one of them is you can actually find index funds associated with different strategies. And I'll show you guys different index funds here with different strategies altogether. And that also kind of stems with cost. So cost and strategy are in line almost. So depending if you have a more specialized strategy, you tend to find a higher cost. And I'll show you guys how to find the cost of any index fund. You can find it for every single index fund you could ever imagine. You can be able to find the cost. And this is very important because the cost actually will have a hindrance on your overall performance over long periods of time. And then we also get the exposure portion of index funds. Well, this kind of goes in line with strategy, but not so much, because you can have a strategy within a given country, but it differs from a different strategy within that same country. What I mean by exposure is more so on that geographical exposure. So index funds can provide you different levels of geographical exposure, as we'll get to in just a second. The other benefit is tax efficiency. As long as you don't sell, as long as you don't generate a taxable event. Okay, so there's a key difference between tax evasion and avoidance. As long as you avoid a taxable event, in this case, it's selling, then you're not going to owe any taxes to those capital gains. Okay, keyword capital gains. Those dividends you might still be able to owe some, but if you hold it in a tax advantage account, not necessarily speaking. So you get that advantage too. And then you also have the benefit of psychology. Okay, so when you invest in an index fund, the whole point is it's considered to be a passive form of investment. It's considered to be a lack of strategy thereof. You're basically passing on that strategy away from you into some sort of predetermined design. Okay, and in this case, an index fund is more passive. It's passive flows of money rather than active management of money. Okay, so that's kind of the key difference. So a lot of people prefer index fund investing because it removes that headache that you might actually experience, which kind of gets into the last point. And these two are starred for a reason because they're very important points. And that is opportunity cost. Well, you out there have a limited lifetime. Okay, so you will one day, if you didn't know this, you will perish. Okay, at one point you will get old. At one point you will stop working. So you have a limited time frame to kind of focus on a variety of topics. Okay, one of those may not be to the benefit of you to be stocks, individual stocks. It may not be to your benefit. It may in fact be to your benefit to kind of think about that as kind of a side thought, and you want to focus on other things, such as maybe generating another source of income, maybe pursuing a career path that requires a lot more attention. And then you want to kind of put that side of, I need to invest in the market, put that to the side, and have that taken care of you with an index fund. So that kind of removes that. And that opportunity cost, or what we are going to compare to, is what you're giving up. So if you choose the path of individual stock investing, or let's say if you choose for the most part or for the vast majority of your assets to be pushed by individual stocks or invested in individual stocks, you are making a choice, and that comes with an opportunity cost. Okay, an opportunity cost is a real cost. So if I have two options before me, and one gives me the cost, or I invest in asset A will generate me $5,000. If I invest in asset B, it generates me $10,000. Okay, let's say I choose to invest in asset A. Okay, I made $5,000, but my opportunity cost was $5,000, $5,000 additional extra dollars, because I would have made $10,000 had I invested in option B. Okay, so these are the things that we kind of think about. Opportunity cost is technically a real cost. Now, I want to just quickly talk about, index funds or indexes versus ETFs. Well, ETF stands for exchange traded funds. The index itself, as we'll kind of get to, they are the actual formulation of the assets. So let's say the S&P 500, that's the index. And then there's a variety of ETFs that follow the index, such as the SPY and a couple others that we'll actually get to. And then you might also have the NASDAQ, and then vice versa, you have also subsequently some indexes, or some ETFs, that follow that index, okay, such as the QQQ, okay, and we'll get to that in just a second. So now I'm going to kind of get into some more specific indexes that are out there, and we're going to actually explore some of them together. So I have this list. You can pause the video here, take a picture of some of these. These are by no means all of them. These are just some of the ones I want to actually explore with you and show you how to find everything there is to know about them. So if I actually take you over to BlackRock's website, and the first one we're going to go for is why not the MSCI World ETF, and this is again by BlackRock. So if I show you this company, or I said company because I want to actually talk to you about BlackRock. So BlackRock is a publicly traded company, ticker symbol BLK, and they are known as an asset manager, okay? So a lot of people like to say, well, BlackRock owns so many companies. No, that's not necessarily the case. They are a custodian. They have your assets with them, and then they, on your behalf, manage and house your money. So they have what's called AUM, assets under management. So BlackRock will hold your assets, and with that kind of provide that additional value where they are basically managing your funds on your behalf through these various instruments, and you get to decide the instruments. So let's say you invest in iShares MSCI World ETF. So what are some of the things that we want to look at? Well, we want to look at first the strategy. Well, what is the strategy? Okay, this is a broad range of developed market companies around the world. So this is a global ETF. So this gives us global exposure. Now, is this just it? Is this where we end? No, we don't. We want to pay attention to that expense ratio. Remember some of the things I highlighted. I said that cost, it was number 2, bullet point number 2. Cost is important. We want to shop around. We want to get the best for ourselves. And look at that expense ratio of 0.24%. We're going to put an asterisk around there. We're going to say, okay, this company is offering me world exposure, global exposure for 0.24%. Doesn't seem like a lot, right? And it's really not. ETFs are a lot cheaper than some other alternatives, but we want to compare it to other ETFs. And then we're going to go down here. We're going to go to some of the assets. We can actually see some of the holdings that they have. So this is where I kind of want to explain to you, and I have other videos on the channel about this if you're so inclined. And I also give you some videos as to how they calculate the PE ratios of a lot of these indexes, which is a little bit more complex. So it takes you down a little bit more of a math journey than something like this would do. But if we look at the sizings here of the portfolio, these are market cap weighted indexes, which basically means that the larger the company, the greater the proportion is held within the index. So Apple being the largest company on earth is the largest holding, Microsoft being right under that is the second largest holding, and so on and so on and so on. And so what you'll start to notice is the vast majority of stocks in, at least actually all of these stocks here, are all part of one country, and that is the United States. The United States at the present moment in time dominates the entire world in terms of capital markets and business. It is the dominant country in the entire world in terms of power, and we know, if we talked about in other videos, the euro-dollar banking system, etc., the dollar being the world reserve currency. There's a lot of, we can go on and on forever. But if we go on to page 2, we should start to see some foreign companies, and I spoke too soon. I don't see any foreign companies. Oh, no, we see Nestle. Nestle's in there. Okay, so finally some foreign companies in there, and we have Nestle. Pfizer once upon a time. I mean, the name German, but it's American for all intents and purposes. And we go down to the third line item. Hopefully we see some other ones. Okay, we see Roche. We do see Thermo. No, sorry. Nope, that's still American. But yeah, they're still there. Let's go to the fourth page. And I could have probably skipped one with my eyes, but I'm just trying to find one. Okay, so what I'm trying to highlight to you guys is the exposure is going to be a little bit different. And we're going to go to another global one. Oh, we have ASML, Toyota. Here we go. LVMH. Let's see here, Danaher. Okay, cool. We're getting some. Let's go to page 6. Okay, page 6. We don't see. So there's actually an interesting point of elimination, which is, again, if we go up to the prospectus up here, the description of the fund, we do see exposure to a broad range of developed markets, okay? And then access to the developed world in a single fund. So that's the key word here, developed world. And then we're going to go over to another fund and kind of see the same thing. Now, on the Vanguard side, Vanguard, by the way, is a non-profit organization. So we have BlackRock, which is a for-profit organization. Not to say that one is better than the other inherently because of that, but just to understand the different goals and incentives behind each one. And in some instances, BlackRock might be more incentivized to treat you, as a customer versus something like Vanguard, vice versa. It just depends on your experience, et cetera, et cetera, et cetera. What I want to highlight is the differences in this one. We have a total world stock market index fund here, or ETF, and that is VT, so ticker symbol VT. You can actually purchase this on an open market. We have an expense ratio of 0.07%. So just to remind ourselves, it's 0.24%. However, the strategy is technically different. So remember what we discussed, strategy. So jurisdiction, we do have different jurisdictions here, as I will show you right now. Let's go to the holdings here, and we should see a difference here in terms of the amount of foreign companies. As far as the top holdings go, we do see basically the exact same. Now, some of the percentages are a little bit different, and that is because of what is held on page 2, which we should see some of them. If not, I will see. Okay, there we go. I was like, they have to be on here. We have Taiwan Semiconductor, something that was not included in the other fund because the other fund focuses on the developed world. And then as we start to see on page 3, you start to get some exposure to Tencent. Where's Alibaba? Alibaba's in here somewhere. But you should also get some exposure to other Chinese companies. And if you're newer to the channel, I have a plethora of content on Chinese companies and my issues with them. But this video is not about that. This video is simply to show you guys some of the differences and key nuances in terms of your optionalities for investing, right? And let's go to page 5 because I have to find it. There we go, Alibaba. So they have Alibaba shares sitting at 0.24% of the portfolio. And again, so we are seeing a massive, massive, massive exposure to American companies. But at the same time, we are getting a tremendous amount of exposure to some of these foreign companies. And if I actually show you in terms of jurisdiction, which actually will be shown at some point here, right here in front of you, you can see that, you know, the North American part is about 62% of the fund. All right, and I will show you guys that by zooming in because you guys probably couldn't see that. 62.6% in exposure to North America, and you can see that there as well in terms of a pie graph. And Europe is 16%, emerging markets is 10.2%. So you don't get much exposure in that regard. Middle East is 0.2%, so making up the smallest. Well, others technically 0, so others the smallest. But in terms of defined geography, Middle East is by far the smallest, and you know that kind of makes sense. Because again, we're doing a market cap weighted index, which basically means that we will invest in the largest companies, we will invest the most, and in the smallest company, we'll invest the least. If I go in terms of the actual final page, and which is if I showed you this, well, you guys can see it here. Look how many pages. Like, let's just scroll it down here. I just want to show you the smallest. Oh, did not go all the way down. Stay there. All right, let's go here and let's see what these companies are. Oh, this is the dividends. So wait, where's the holdings? Right here. Oh, okay, so there's no holdings here. I don't know why it took me there. Okay, so if it doesn't have any holdings there, I want to go to the last holdings. Come on, Vanguard. You have like all these empty pages. Okay, so I guess it doesn't have anything here. Okay, I'll just go here. Fine, whatever. So we see all these companies that you probably never heard of. Some of these companies you definitely never heard of. So you're getting a massive, massive amount of exposure. What you're basically doing is you're saying, I don't want to even think about it. And I want to let the world resolve all of its issues. And that's basically what market cap weighted indexes do. Market cap weighted indexes, even in terms of just the United States, which I'll actually compare because I know that some of you are very curious. You say, how has the performance been? I want to know the performance. And we'll actually, I'll show you that here because I think that's important. So let's go into this and we're going to do VT. And let's actually pull it up like this. Google has this nice little feature, and we are going to compare VT to another one from Vanguard, which is VOO. Okay, so VOO. And remember, let's go back to this. So we have an expense ratio. So let's remember the expense ratio of about 0.07. Okay, typically, the more complex the strategy, the more you're going to pay. But again, you might be justifying to yourself why you're going to pay that. So VT versus VOO. VOO is just exposure to the United States, and that is the S&P 500. You can see over the past day, it is no, I'm kidding. You shouldn't even care about that. That was a joke, by the way. We have to have some jokes here. But let's take a look at the 1 year. So the 1 year, VT has actually underperformed the overall market by going down about 17.94%, while the S&P 500 is down 11.78%. But you got to be careful with that because future or past performance is not indicative of future performance. Now, we take a look at that 5-year performance. We again see some outperformance by the S&P 500, up about 58.46% relative to the total World Vanguard Stock Market Index Fund by about 26.87%. Again, what you're getting with that, or what was the lagging factor behind that, is a lot of that exposure to those foreign stocks. Foreign stocks did not do well during this time period relative to the United States. However, in some markets or in some time periods, foreign stocks might do better or worse. It really does depend. Now, I want to kind of counteract that with some points to some food for thought for you guys, and that is, well, American companies are very large. Their operations are very vast. They're in all these different business lines across the globe, and in some cases, you might consider them, hey, American companies, they're basically foreign companies, right? In a lot of respects. Is Apple a just domicile American company? No, it's a global company that sells iPhones everywhere in the world, right? Google, same thing. Meta, same thing. Adobe, same thing. All these businesses are just operating everywhere in the world now. And so from that case, you might be saying, well, I have a lot of exposure to the world through a lot of these companies in the S&P 500. And I'm specifically highlighting the S&P 500 because the S&P 500 is those 500 very large companies of the United States. Okay, and I actually want to highlight, not all companies. Well, let's go over why market cap weighted. Okay, well, market cap weighted has a self-cleansing feature. Okay, because a market cap weighted, if your goal is to be passive, well, then what better way to do that than to have a cleaning up feature? Well, if the new up and coming stocks continue to rise, well, perhaps there's some merit to it, right? Perhaps they're rising because their quality is good, their quality is improving, and the market is rewarding them as such. So wouldn't you want the portfolio to cleanse itself of the underperforming stocks, the ones that are going down in market cap, and then start allocating more to the ones that are going up in market cap? So that's the idea behind that. That's one of the ideas is why the indexes are designed that way in a market cap weighting. So it's basically, again, providing that structural passive approach. Okay, so I want to actually go over VOO. And we go back to Vanguard. And if I were to show you how to do it, you could go up here, and then you can go to the search bar, and then you type in VOO. Okay, so VOO, it should take you to the S&P 500 index fund right there. You click it, and then it takes you right to it. You're right here on the page. You can, again, see all the information you would like. Look at that expense ratio, 0.03. So the expense ratio is smaller because, again, it is a simpler index. It also actually is determined by the amount of capital that actually goes to it. Vanguard actually, over time, tries to lower those fees over time because, again, nonprofit, et cetera. And they can actually generate, in terms of absolute returns, more if there's more assets under management, or AUM, again. So 0.03%, it is less than half of the expense ratio of VT, and you are getting that exposure to the S&P 500, which has performed better in the last decade to VT. But remember the cautionary approach. So if you go down to the holdings here, again, you're going to see Apple, Microsoft, Amazon. You're going to see a theme here, okay? And that's just how it's going to be. And then some other ones I want to go over with you is VTI. So VTI, unlike VT, gives you that total market towards the United States. Okay, so this is the United States, and we see the expense ratio at 0.03. So this is if you're like saying, I just want exposure to the United States, and that's it. I want small cap, medium cap, large cap, I want it all. Here you go. There's a fund for you. And what I'm trying to highlight to you is there's almost a fund for everyone. Any kind of strategy you want to pursue, there's one for you. And we're going to get into some more intricate strategies later in the video, or pretty soon, actually. The last one I want to go over with you is VTX. So VTX is the foreign stock market. So this is total foreign stocks. Okay, so this has I actually clicked on VTI. Oh, I'm having like a little bit of a brain fart. It's VXUS. VXUS. Okay, so VXUS. So this is the international variant. And again, we're going to get into that more expensive expense ratio. You can see it right there at 0.07%. So exactly the same as VT. What you're getting here is just the foreign companies, so it's excluding the United States. And so if we go down to the largest holdings, what we should see is basically a massive exposure into emerging markets, Europe, Pacific, and you don't see North America really being big because it's only including Canada. So if we go over to the portfolio, we see the largest one being Taiwan Semiconductor, Nestle, Tencent, Samsung. So why would you choose this one? Well, so let's say your theory is that the United States has performed really well in the past decade, and you believe, you could be wrong, you could be right, but let's say you believe that foreign companies are going to perform better over the next decade. Well, if you believe that, this allocation might make sense in a form of a low-cost index fund that provides you that exposure. Remember, what do you get with VT? Well, VT is a kind of a statement saying, I don't care, I'm going to just buy the whole thing and I don't really care where it goes, okay? I'm doing it for different reasons. I'm doing it because I don't really want to think about now I should have exposure to foreign stocks. Now I should have exposure to domestic stocks. You're just like, I'll own it all and I'll let the world settle it. This is kind of a statement that you're making, and you're saying, okay, well, I'm going to have some exposure to domestic stocks here, and then now I'm going to go have some exposure to international stocks. Or you're looking to kind of change up the blend that something like VTI can give you, and then VXUS, and you want to change the weighting that VT gives you. So it allows you for that customizability. Of course, what you're going to end up doing is paying a little bit less actually in that strategy in terms of expense ratio. So if you actually calculate the total expense ratio, you might actually end up paying, instead of paying the totality at 0.07%, you're going to be paying a portion at 0.03% and then the other portion at the 0.07%. So in some ways, it's going to take a little bit more work, but you actually can min-max it. So for those of you who like to play video games, you know what min-maxing means in a video game. You can min-max your financials, technically speaking, on that front, but that's going to be very minimal. So I kind of just went over with you some of these instances. One specific type of index that I actually want to go over is the QQQ. So QQQ, of course, they're going to highlight this part, that the QQQ has outperformed the S&P 500 over the vast portion of this time period. And well, why is that the case? Well, the QQQ is invested in the NASDAQ 100, or it's supposed to follow the NASDAQ 100 index. Okay, and that's mainly a lot of these technology companies. If you see, it's the 100 NASDAQ companies, and I want to show you their holdings. Let me see that. Where are their holdings? Okay, if I go to the prospectus, I should be able to show you some other things. But if you read through this, you can kind of see what it was for and stuff. But I actually want to find their holdings before I get distracted on other things. Okay, learn more. Let's go to learn more. It's probably in here. Show me your holdings. Product details. Oh, I didn't mean to do that. Product details. Let's go to product details. There we go. Finally, there we go. So we can see all holdings. What do you notice about this? Well, a lot of the companies in here are also heavily invested in, but this is more to a greater extent. And so what basically this fund has benefited from is that technology has been such a vast amount of the growth in the markets over the past several years. And so the NASDAQ has actually experienced a vast amount of growth relative to the overall index, because the index, the S&P 500, has a whole bunch of companies in there that aren't technology companies that have been doing really well. So again, you can get that exposure, but there are so many different types of indexes out there for different strategies. I'll actually go over some of you, but this is by no means a endorsement of sorts. So we'll actually go here and I shall show you some bond index funds. So if we go to TLT stock, let me show you that one. So this is actually showing you a strategy specifically for 20+ year Treasury bond ETF. So let's actually go to the white background, because I think that's a little bit better for us. But this one's going to show you a strategy focusing on 20 years plus. If you can also go and see their expense ratio, but this is someone who wants to bet on rates going down. For example, I'm just giving you an example. And then this is one that I utilized more recently to kind of bet on rates going up. And it's another variant of it, but this is kind of the opposite trade. So this is shorting, right? And this is actually ultra pro. So what I want to say is, be careful. This one takes on leverage. So there are leveraged ETFs on top of that I'll actually showcase to you. Well, this is the first one that I'm showcasing to you. So the problem with leveraged ETFs is that with these kinds of strategies, you do have let me show you. Let me just show you the visualization will tell you more than my words. This is not something that is a long-term strategy. These are meant for specific moments in time where an investor who is confident enough to make these decisions can implement this in their strategy. So you can see over the long period of time, this is not something you want exposure to. But over a short period of time, it is a way of making a sort of bet of sorts, a placement of capital that would benefit in a very specific scenario. Okay, TLT, on the other hand, it is not leveraged, and it has benefited tremendously from this specific strategy. If I show you from the totality of its exposure, it has gone up about 33.76%. Again, it has served also really well in terms of when an investor wants to kind of make a presumption that rates will go in a specific direction, specifically down. So if you, for example, believe that the Fed will pivot, right? If you believe that they're going to lower rates, if you believe rates are going to go down, and that it's going to be reflective of the long-term projected growth of the United States, all that jazz, this might present an interesting strategy to you. I'm just giving you guys examples over and over and over again and showing you. And this is kind of just the taste of what's out there in terms of strategies. Now, you might have heard of these index funds that are this, QYLD. Okay, so QYLD. This is a covered call ETF. So this one is for someone who's looking for income. Now, I have reservations and more negative things to say about this strategy than what I see out there on YouTube. But I'm just kind of just showing everyone, and like there's just a lot out there, right? So this one focuses primarily on covered calls on the NASDAQ 100, literally right in the name. And a covered call is a complex strategy that if you don't know what it is you're getting into, you probably shouldn't really touch it. Income be damned, okay? I'd prefer to, make money rather than lose money. And if I want to kind of be calm with my money, I want to invest in things I understand. So for the most part, people shouldn't really be involving themselves in these strategies. I see a lot of people involving themselves in this particular strategy and not even knowing or understanding exactly how that is executed and how the performance might be over long periods of time as, kind of subpar. If we look at the max performance, it is still down 29.26%. There are other variations of these covered call strategies. There's one for the S&P 500, et cetera, et cetera, et cetera. So just kind of opening your guys out there for some of these ideas. There's one for the airlines. I'll actually pull that up here. So if I show you Jets, for example, Jets is, again, this is not endorsements. I don't want you guys to think that. But Jets is an ETF that focuses on the airlines. And let me actually show you. Let's actually find out who provides Jets. So if I actually go here and I click Jets ETF, we should be able to find them. And again, it's pretty easy to find. So there we go. And I see the expense ratio 0.60. Like I told you, it is a correlation, a very high correlation. The more complex, the more specific the strategy, the more expensive the expense ratio. So you don't believe me? Let's go over to TTT ETF. So TTT ETF, and let's see what's up with this. So let's go here and let's find it on ProShares. And we can see it's a 3x leverage ETF. The expense ratio should be pretty easy to find. And that is, where is that expense ratio? 0.95%. So very expensive, especially relative to those other index funds that I was showing you earlier. All right. So, and then kind of I want to finish off with some last key points, and that is some topics regarding mutual funds and hedge funds. Okay. So you might have ever wondered, what is a mutual fund? Well, a mutual fund is managed by a pro. And those quotations don't mean that they're not necessarily pro. It's just, quotations for pro, okay? And then stock funds, bond funds, different strategies. There might be a different strategy depending on what mutual fund you're really looking at. Mutual funds will have higher fees. They're actively managed. And so I'm kind of giving you just a bird's eye view of this. But stock funds, bonds funds, they might focusing on different strategies. And again, that can vary in terms of performance. And it blends a strategy of small, medium, and large. Okay, so the idea is that it gets you as much exposure. There's supposed to be a way for diversification. And they're very open to anyone. That's what, kind of in the term mutual fund, it's very welcoming, very opening, right? But a lot of bogleheads especially will point out that mutual funds have underperformed and index funds have outperformed mutual funds over long periods of time. So an investor might be better off just investing in index funds to begin with. So that's probably more the case than anything. And now a hedge fund. What is a hedge fund? Well, inherently in the word, in the name, hedge fund, what this implies is an entity that is basically there to hedge your bets, right? So they typically have a long short portfolio, and included in that name, a long short portfolio is ideally supposed to benefit in whatever environment. So hedges a long short portfolio implies a long position and a short position, or long positions and short positions. Think of Dr. Michael Burry. Dr. Michael Burry is long some companies like Meta, some of the other companies that actually we have in my portfolio, and like Global Payments, for example, Warner Bros. Discovery, but is short other positions such as Apple, and he's short positions in the form of contracts or put contracts, but we'll get to that in another video. And just to understand, all in all, we are looking at a long short portfolio. It is a hedge fund. And so something that we want to kind of talk about is ideally, it should benefit in any environment, or at the very least, reduce the volatility of the overall fund. So you have a more streamlined approach. It gets the investor a little bit easier to sleep at night. And some people are not some people, a lot of people are actually willing to pay for that. So who invests in these entities? Well, typically, you can have employment funds. You can also have high net worth individuals. So this is not your typical person. This is typically a massive pool of funds that is then given to the manager. The manager takes their fees. The fees can vary in terms of performance-based fees or just standardized fees that are taken every year. So all in all, what really matters, or what actually matters at the end of the day for all of these industries, and I'll actually say this as a closing thought, many of the entities we did discuss do really care at the end of the day about AUM, assets under management, and they're going to kind of present themselves in any which way or form that benefits them. So I have no skin in the game in this sorts. I do not seek, your funds. I'm only, seeking this video to kind of just open your eyes to that. And the ones that benefit the people the most typically have been at least over the past 30 years. This could, of course, change, and this video could be wrong in this instance, but I'm telling you, for the past 30 years, people probably more often than not would have been better off in broadly diversified index funds, or ETFs, to be more precise, and not so much these mutual funds. All right, so mutual funds, not so much, but of course, you could have found some. For example, we have Peter Lynch, who ran the Magellan Fund for a while, and he actually really did outperform the market. But some of the things that, we're going back to some of the key benefits of ETFs is that psychological aspect. Well, one problem with an investor, your worst enemy as you begin your investing journey, or maybe you're on your investing journey, is going to be that psychology, that brain. So something kind of like the metaphor of what Peter Lynch kind of talks about, and I'll kind of break that down. He says the most important organ for investing is not the brain, it is the gut, right? Obviously, the gut is an organ is actually not important at all. It is the brain because it's the psychological aspect. But you get the metaphor behind that. What he's trying to say is it's not about your intelligence. It's not about your intelligence. Actually, you don't have to be that intelligent to be successful in the market. You just have to have the willpower to kind of bear through things. Now, that is with the caveat that, you're not just like bearing through because you're stubborn through your mistakes. You have to identify when you made a mistake and then course correct. But it's when you can kind of realize, okay, I didn't make a mistake. I know what I bought. And, the market is presenting perhaps a better buying opportunity, right? And so you can kind of play around with that idea, play around with your investing style, whether or not you want broadly diversified index funds, you want some exposure to individual stocks, and at the end of the day, try to minimize those fees that you end up paying to, Wall Street or a financial advisor, et cetera. Shop around for what is, best for you. Okay, so for index funds, I kind of showed you a very easy way. It's extremely easy. You just explore, look around, pay attention to those expense ratios. I bet you can find a very similar strategy. Maybe you accidentally stumble upon the cheapest one, but maybe not. Maybe there is another one out there that actually offers the same exposure just for less cost, and make them compete for your money. Make them do that. Don't just settle. Just make them really compete for your money and shop around. A lot of them are going to be very competitive. They're going to be very the same in terms of fees. So, that's the beauty of the market and competition, et cetera. So that's something to benefit from. But again, over the past several years, managed funds, not so good. Index funds, very good. And then you want to consider learning about, what your nation, because I'm going to say in an international sense, because remember, the capital mindset community is about 50% European. So everyone around the world, look and explore what your country, what your government has offered you in terms of retirement accounts. They may or may not have one, but for the most part, a lot of the developed world has these options available to their citizenry. And then this is a way for you to kind of maximize those return potential by not having the fear of taxes, because even when you have those non-taxable events, by just not selling, right, your index funds, you still have to pay taxes on the dividends that are received, except if you put it in a tax advantage account. Well, you don't have to worry about it at all. So that's a benefit, right? So just think about those things and kind of explore these thoughts. Go out there and shop around. Figure out what is your style. Would you prefer a mix, a match? Maybe you want, 5%. So for example, there's YouTubers that, advocate for a 5% allocation to individual stocks, 95% allocation to index funds. For me personally, and this is not to be followed, for me personally, at the present moment in time, I don't have any index funds. However, I can tell you for almost certainty of fact that, I have no idea what I'm going to be doing in the future, but there are a plethora of career paths ahead of me that in fact may force me down that path to kind of actually utilize index funds, because by law I won't be allowed to pick individual stocks. That actually might be a thing. And so in which case I understand more or less which ones I would rather pick. All right. And I would pick a blend of exposures and I would also pay attention to those lower costs. And that's if I want exposure to individual stocks, because there's also private businesses, and a lot of the same lessons that you take away from stock market investing can be applied to private business, okay, and even to real estate. At the end of the day, the principles are more or less the same across the board. The nuances will vary depending on what entities we're talking about. So you might be applying different analysis to that company versus that company versus that company, and that's part of the game, right? And if you make a mistake, it's all on you. But all in all, I hope I did a good job of explaining some basic stuff. This is basically episode 1 of the Capital Mindset course, a very basic one, kind of introductory video. Again, if you found value in this video, feel free to share it with someone who's kind of just getting introduced to the market. I know this is a responsible video. This is not one that, I'm telling you guys, oh, you're going to make a ton of money, you're going to make infinite money. But yes, I will be doing more videos on this very topic. Well, not specifically index funds, because, we pretty much covered that. But the next episode should be geared around specific, or the hierarchy, the performance hierarchy, and as well as some stuff about stocks and brokerages and the benefits of different brokerages versus another, and as well as perhaps getting into some options, because it has been requested a lot by you guys, and I didn't forget about you, the one who requested it. I am working on developing one in a responsible fashion. Okay, so with that being said, thank you guys so much for watching, and I'll see you guys on the next one. Bye.